This is what the average guy's portfolio looks like. It's okay, but let's be honest, it's a bit dead. This, on the other hand, is what the typical ultra high net worth's portfolio looks like. Now we're talking. In this video, I'm going to break down what the ultra high net worth portfolio is for you guys, so you pick up all of those hush investments that these guys are making every single day. There's so many lessons to be learned by just studying where they put their money. We're all about alternative investing, where we go and discover those uncommon, undercover investments that savvy investors are making all over the world. Subscribe and follow for more. Remember folks, there's more to life than the S&P 500. If you study where they're actually putting their money, these ultra high net worths, the key thing is that 46% of their portfolio is going to something called alternatives. And what we're going to do in this video is unpack exactly what these alternatives are and what this 46% is actually going to, because there's actually different things in this bucket. But first, let's just set the stage on why on earth ultra high net worths care about alternatives in the first place. What's this investment class got going for it? Numero uno, inflation. With inflation in double digits at this point, people are looking to put their cash in places where it's going to be safe. So if you're holding your money in cash, obviously a bad idea. But why is alternatives a good option? Because alternatives are made up of typically real assets, tangible, real things, companies, properties, etc. And the benefit of that is that real assets hold their value a lot better during an inflation period than just cash or other asset classes. Numero dos, alternatives will typically outperform the stock market over a long period of time. Wicked. Numero tres, the stock market is not correlated with the alternative investment landscape usually. What that means is, with the stock market currently going like your heart after a long run, it's not going to be affecting your alternative investment portfolio, which is going to be a lot more stable. Numero cuatro, and this is a particular favorite of the ultra high net worths, you can save tax very effectively using alternatives because they are typically structured in private companies, often offshore, and you've got a lot more flex about how you can save tax and also be really efficient with inheritance as well. Numero cinco, you're going to be able to diversify within this 46% alternative investment part as well. It's not just one monolithic investment, there's actually different things within this pot as well. Right folks, so we're pretty pumped about alternative investments. And now we want to know, what on earth are they? Where are we going to put our money that is allocated for alternative investments? Let's find out. So as you can see, your typical high net worth, ultra high net worth is putting a lot of their money into private equity. And then after that, they're going to mix it in with a little bit of real assets, that's property, commercial real estate, and also a bit of hedge funds. And then they've got this thing called other, which might be things like crypto or derivatives, or all sorts of other weird and wonderful things that the ultra high net worth invest in. Could be artwork. And this data makes sense too with what we see in the news. If you look at top celebrities, people like Jeff Bezos, Snoop Dogg, Mike Tyson, Serena Williams, all of them are investing in a pretty big way into alternative investments, and they're making some serious money from it too. For heaven's sake, Mike Tyson was broke after earning $200 million from his boxing career, but then has made a ton of money back using venture capital and early stage investing into startups. Crazy. Why are they doing this? Because, ladies and gentlemen, they can. You see, alternatives is usually not that accessible. You need high minimums and you need to be a bit of a high roller and in the know to get access to these kind of deals, or work in the financial sector and have access to these deals as well. If you don't have that, it's very tricky. That's probably why you have never heard of it. Or if you have heard of it, you probably don't invest in it. But there are actually now some pretty decent options for relatively ordinary, if affluent folk to get access to this stuff. AngelList is a really big name in the venture capital scene when you're looking to invest in startups. Moonfare is the new kid on the block where it allows you to invest in private equity and growth funds. And then of course there's little humble us, Curate Capital, where you can get access to venture capital and commercial real estate investment as well. But Ibrahim, you say all of this stuff, but isn't this inappropriate for me? Because the ultra high net worth can take this risk because, well, they are ultra high net worth. They have money that they can risk losing. What's that all about? Yes, posh Ibrahim, but there is a really good reason for it mathematically why investments in alternatives actually work and may not be necessarily as high risk as you might think at the first glance. Imagine you had invested $3 into 20 companies with a potential upside capped at, let's say, 50% profit, but you were going to have a fail rate that was relatively low of, let's say, 2 out of 20 companies you would expect to fail. After the investment period was over, you would have had 2 companies that failed, and 18 companies would have made you $27 in total. So overall, you'd have been a bit of a winner and you'd have made some money. Now imagine you invest $3 into 20 companies again, but this time there's a failure rate of 10 out of 20. So half of the companies are going to fail. But this time you have a potential upside of up to 100x, 100 times the potential return that you put in. Now let's play out what happens. 10 companies fail, so you get 0 for that. After that, let's assume that you have 5 companies that do a 3x return. So that gives you something like 45. And then let's assume that 3 of the companies do 10x. That gives you $90. And then let's assume that the final 2 companies do 100x. So if you add all of that together, you get $735. Okay, nice, Ibrahim, that's great. But what exactly are you trying to say? Well, what I'm trying to say is that if you bundle together a number of risky assets into one basket, you are actually reducing the overall risk because you know some of them are going to flop. Because what's the risk of a risky asset? It's going to flop. So what you do is you bundle them all together, and then you know that at least some of them are not going to flop. And the benefit of risky asset is it makes big returns. And so if you bundle them together and you take some really big risks as well as part of that, you end up having some really serious outcomes, and that makes the overall portfolio work in a relatively risk-adjusted way. Fun fact, folks, we've actually co-invested on a deal with Serena Williams and Jeff Bezos. We haven't yet invested with Snoop Dogg. That's a life ambition of mine. One day maybe. Snoop, if you're watching, love to co-invest with you. Hit us up, as long as it's not some illegal drug that you're investing in. That is it for today, folks. Please do subscribe and let me know in the comments below what further topics or alternative and crazy investments you would like me to cover next. Until next time.